And we're back. Treasury stock, again, is when a company buys back their own stock that is known as treasury stock. We use the cost method to account for treasury stock, meaning that we're going to debit the treasury stock account for the amount that the company paid to acquire or reacquire their own stock. So treasury stock is a contra stockholders equity account. It is going to reduce the total of your stockholders equity. That's because stock, which was sold to the stockholder, has now been reacquired by the company, henceforth reducing the total of their stockholders equity section. For example, we have Mead Inc. They have so far issued 100,000 shares of common stock that has a par value of $5. So notice that common stock is recorded at its par value amount, $5, 100,000 shares, $500,000. Then on 31st, they acquired 4,000 shares of its own stock at $8 per share. Not per share, but at $8 per share. So to record this, go back. What you doing? Sorry. So to record this transaction, you would debit treasury stock for $32,000. You always record treasury stock at the price we paid for it, $8 per share times 4,000 shares, and credit cash $32,000. Again, debit treasury stock $32,000 and credit cash for $32,000. You always debit treasury stock at the amount that it was paid for. So now take a look on the balance sheet. So now the treasury stock account is shown as the contra stockholders equity account for the $32,000. It's going to reduce the total of the stockholders equity. Where initially, remember, the amount was $700,000, but because we bought our own stock back, now the total of equity is $668,000, which brings out some other terms. When it comes to stock, that's what we call authorized stock, issue stock, as well as outstanding stock. When you think about authorized, in this case, they can sell up to 400,000 shares of stock. That means the state decides that they can sell up to 400,000 shares of stock. Now, issued means 100,000 shares of stock had been sold to the actual stockholders. All right? But we then bought back 4,000 shares of our own stock. So the shares outstanding, which is the number of shares of stock in the hand of the stockholders, is 96,000 shares. To calculate the outstanding shares, you take issued shares minus treasury stock to get outstanding shares. Again, issued shares minus treasury stock equals outstanding shares. So 4 terms you know about: authorized shares, outstanding shares, and issued shares of stock. Okay? Got those terms down? Next up, dividends. Dividends are payments made to the stockholders when a company has a good year financially. They've made a profit most of the time. They may decide to issue dividends to the to the stockholders. Dividends can be paid in different formats. Most common are cash dividends. For the most companies, they only issue cash dividends. Sometimes there could be stock dividends. We talk a little bit about property dividends and what's called a scrip or promissory note. So with a property dividend, which is very uncommon, you may have this more with privately held corporation. Rather than paying you cash, you're going to receive some type of property, some type of asset as a form of a dividend payment. Again, this is very uncommon except for when it comes to privately held corporation. With a stock dividend, rather than paying you cash, they're going to issue you stock. So with a stock dividend, they may say, well, rather than giving you cash, for every 10 shares of stock you own, or 100 shares of stock you own, we're going to give you one additional share of stock as a form of a dividend payment. So with a stock dividend, rather than paying out cash to the stockholders, you're going to give them stock as a form of a dividend payment. With a scrip, which is a promissory note, this was kind of funny. They're not going to pay you anything right now. They're going to give you an IOU. So they're like, hey, we're going to pay you dividends, but not right now. We don't have the money. Maybe 6 months from now, a year from now. But the promissory note is an agreement where they're promising to pay you dividends at some point in time in the future. Again, the scrip, property dividends are not that common when it comes to public corporations. You may see these more with privately held corporations. Okay. Now, before you can receive dividends, the board of directors has to approve them. So the board has to approve dividends, being paid to the actual stockholders. When dividends are paid out, they're going to reduce the retained earnings of that business organization. And we're focusing on cash dividends, okay? So when it comes to paying out cash dividends, they're going to impact retained earnings. There must be adequate cash to pay out in the form of dividends. And again, dividends must be approved by that company's board of directors. Now, there are 3 important dates pertaining to dividends. What's called the declaration date, the record date, and the payment date. The declaration date is when the board declares they're going to issue dividends at some point in time in the future. There's an actual board meeting will take place. During this board meeting, they're going to have what they call the minutes. Somebody will take minutes of that meeting. Those documents, those board minutes, become legal documentation. That board minute will indicate the amount of dividends to be paid, when to be paid, etc. So that when the board declares they're going to pay out dividends in the future, that date is known as your declaration date. Next, you have the record dates, sometimes called the date of record. This is saying that whoever owns the stock as of this date will receive the actual dividend payment. So whoever owns the stock as of this date is going to receive the dividend payment. So this tells the companies who they're going to pay the dividends out to. So whichever stockholder registered as owning the stock as of this date, they're going to receive the actual dividend payment. Then you have the payment date. This is saying this is the actual day we're going to pay out the dividend payment to the actual stockholders. Okay? Now, 2 of these 3 dates require you to record a transaction in your general journal. Let's go through some transactions to see what transactions will be recorded and on which date. On December 1st, the board declares a dividend of 50 cents per share on cash dividends of 100,000 shares of $10 par value common stock. The dividend is payable on January 20th to stockholders of record on December 22nd. So we're going to be in December of the current year, all right? We're going to pay them dividends on 1/20 of the upcoming year. So on December 1st, when we declare the dividends, we'll debit cash dividend for $50,000, 100,000 shares times 50 cents, and credit dividends payable. So on the declaration date, you would debit cash dividends, credit dividends payable. The 22nd is the date of record. No entry is required in the general journal. We'll just make note of who are the registered stockholders of our stock as of this date. Because when we do send a payment out, we'll send to those stockholders who are registered stockholders as of the 22nd of December. Then next year on January 20th, we're now going to actually pay the stockholders. So when we pay the stockholders on 1/20 the next year, you would debit dividends payable for the $50,000 and credit your cash account. So once again, when you have these three different dates, on the declaration date, you're going to recognize and record the dividends. Your debit dividends, credit dividends payable. And when you pay them, a payment date, debit dividends payable and credit your cash account. Okay? Now, when it comes to preferred stockholders, they're paid dividends based upon the stock's par value. Typically, they're going to receive a percentage of the stock's par value as a dividend. Now, dividends can be what we call cumulative. What does that mean? It means that if dividends were not paid in the current year, they're going to accumulate. So when we do have enough money to pay out dividends, we must pay the preferred stockholders for the dividend we call in arrears. These are dividends that were not paid in previous years, but are owed to the preferred stockholder. So when we pay out the dividends to preferred stockholders, we'll pay any dividends in arrears along with paying out the current dividends. Let me put things in perspective. So we're going through this pandemic, right? And perhaps you're saying, I'm not able to pay my rent for the month of April because my job is putting me on furlough, I'm not working, what have you. The landlord says, okay, I'll give you to July to make your rent payment. But when you pay in July, you have to pay the rent for the month of April, the rent for the month of May, and the rent for the month of June. Any rent that wasn't paid in past 2 months, we call those or in arrears. So it's the same concept. So when we pay out dividends, we must pay the preferred stockholders for any dividends owed for previous accounting periods, as well as the amount owed for the current accounting period. For example, over here, let's say that we have 5,000 shares of 7% $100 par value cumulative preferred stock outstanding. Each $100 share pays a dividend of $7 because you take 7% of the par value, and there's 5,000 shares, so $7 a share times 5,000 shares, we owe the preferred stockholder $35,000 each year. This saying if dividends are 2 years in arrears, it means we owe them $35,000 per year times 2 years, so $70,000 is the amount in arrears, plus we're going to owe them $35,000 for the current year. Therefore, the total amount owed to the preferred stockholders would equal $105,000. So if dividends are cumulative and preferred, when you pay the preferred stockholders, we must pay them the amount owed from those previous years as well as the amount owed for the current year. Okay? So I'm going to come with one last video to summarize our Chapter 11 information. Okay, almost done.